Hello everyone, I'm Renee Lobo and welcome to the Renee Lobo Report, bringing you issues of topical interest. Today we're going to be topping out a very topical issue and a very important issue to many people. And this is the new initiative that's been taken by the Internal Revenue Service. It's called the OVDI. It's Overseas Voluntary Disclosure Initiative. And it started earlier this year, 2011, and it's going to be ending this month, August 31st of 2011. So very important for foreign bank account reporting by U.S. citizens and with their assets, and telling us how we can comply with this. And this show is completely for educational purposes, and you have to go through your own CPA as well as your legal attorneys for this foreign bank account reporting. This is completely as a practical tips and some advice. So you get cognizant about this issue. So it's very educational, but please do get your information from your CPA or your attorney. So talking to us about this OVDI, which is Overseas Voluntary Disclosure Initiative by the IRS, we have with us two experts. They are certified public accountants, and we have Cecil Nazareth. He's been working as a CPA and chartered accountant for over 25 years. It's a pleasure to have you here with us today.
Thank you.
As well as Vinay Navani, and he's a CPA, and he's from the Wilkin and Guttenplan company, and they are consultants and certified public accountants. And both Mr. Nazareth and Navani have been working on this issue for quite some time. They're very well versed on this topic, and they're going to give us some very useful practical tips on Overseas Voluntary Disclosure Initiative that has been taken up by the IRS. Let's start off first with, this whole initiative by the IRS was taken earlier this year, and it's pretty much ending in about a couple of weeks from now. And a lot of people are getting very anxious about it because they have a lot of assets and foreign bank accounts in different countries, whether it's India or any other country in the world, and how they're going to go about it, who qualifies, who has to put in these forms with the IRS, and the penalties could be very severe. It could almost be your 30-40% of
Yes.
of your account going into the IRS. So either way, people are thinking they're losing it, on this whole issue. So tell us first of all, who has to file these foreign bank account report with the IRS?
Okay, very basically, Renee, it's anyone who has a bank account where the balance exceeds $10,000 in any financial year.
Right.
And that could be cumulative also. So if you have 3 bank accounts of $5,000 each, then you would still qualify to file the FBAR reporting. Okay, now there are two sides of it. One is the income side and the asset side.
Right.
Okay, we want to be very clear with that. The FBAR is a form. It's not a tax form. It's a Department of Treasury form. It's TD 90-221. What it does is you file that with the Department of Treasury in Detroit. You do not send it to the IRS because they won't know what to do with it. Okay, so make sure the FBAR form has to be filed on June 30th of every fiscal year.
Now, can they download this form?
Yes, all the forms are available at the IRS website. You just type in the IRS website and you can download that form, fill it in, and mail it in. For the current year, we are already late, so the last date was June 30th, 2011. Okay, and then you focus on the other side, which is the income side, and Vinay will talk a little more on the income side and how it gets taxed, etc., etc. But FBAR is a very unique form. But it has been on the books for a long period of time, but we've not been, right now the IRS is really enforcing that side of the house. So it's a Department of Treasury. Send that form right in June 30th. It has to be received there every year that you have that foreign bank account report.
So June 30th of every year, but right now the deadline is August 31st to file in their form and send it out. If you have more than $10,000 in worldwide income, you do qualify to send this foreign bank account report.
Let me just make a slight clarification. The June 30th date is based on the prior calendar year, and the $10,000 is based on the assets.
Right.
So if I had a bank account in a foreign country, and the balance in 2010 at any time was $10,000, 500 or higher,
Right.
then I have to file
Right.
this form. I may not have earned a nickel of any income on it,
That's right.
but that form has to be filed.
Right.
And that filing is completely separate from my income tax Form 1040 that I'm used to filing on April 15th. And that's why, because they're so separate, a lot of people didn't know about this FBAR requirement and just weren't aware of it.
Right. Well, the IRS did have something in 2009 similar
Correct.
to this.
They had a similar program to this that really came out of some Swiss banking scandals, and they had a similar program. They encourage people to come forward. So now there's a second generation of that program that's happening now this summer.
I see. So they have August 31st to
It-
file
it-
it.
well,
The last date to file is August 31st.
The last
It should be
date-
stamped as August 31st.
The last date for this program,
Yes.
which is which is really what we're going to talk about today, is a very big decision as to whether somebody's going to enter into the offshore voluntary disclosure program. And if they decide to, August 31st is the deadline
Right.
to do that, okay? If for someone not entering into the program, the deadline for the June 30th FBAR
Right.
is really already over, okay?
Right.
There are some limited exceptions, but,
So they will be penalized then?
well, they
just the beginning of-
they might be able to, if they haven't filed their 2010 FBAR,
Right.
they should look very seriously into the program, because they might be able to do it without any penalties, depending on the amount of income that was associated with the account.
Now, the two different issues, one is the FBAR reporting, the other was the income tax. So let's say
Correct.
when you file your income tax returns, April 15th of this year, you put in that, okay, I had this much of foreign bank account, whether it was 5,000, 10,000, whatever it was, or 100,000, you still have to, it's mandatory that they have to file the foreign bank account report.
Yes.
As long as the balance in the account was more than 10,000.
More than
If I
10,000,
had an
exactly.
account with $3,000,
It's okay then.
I still have to report the income
Right,
on my 1040, but
Right.
I don't have to file the FBAR.
exactly.
And one
Now-
clarification there, you even could have a signatory authority. Don't just go by the bank, they focus on the signatory authority. So you want to focus on that too, just not the balance in the account, because you could have signatory authority like a joint account, but you never used it, so.
So even if
be
you have a joint
mindful.
account.
Joint account,
you
your
still
spouse
have to
has
file a-
10,000.
Yes.
And you have signatory authority, or your mother or your father or siblings, and you have signatory authority, then you're still into that.
So both have to file?
Yeah, you can file a joint one.
Joint one, exactly.
But you need to
Now,
comply.
when we talk about a U.S. taxpayer, you know, people think, okay, a U.S. citizen, a green card holder, but I think it's also for H-1 visas.
That's a big misconception. It's very hard to be a U.S. citizen. It's very easy to be a U.S. taxpayer.
Right,
More or less, the rule is based on the number of days you're in the U.S.
right,
And I can give you an extreme example that if somebody's here more than 183 days illegally,
right,
without a proper status,
Right.
they're still subject to tax as a U.S., in the same way that a U.S. citizen is taxed. And as a U.S., so that's why we use the term U.S. taxpayer. So that's the H-1 candidates, the green card holders, as well as the citizens. And the important thing is that once you become a U.S. taxpayer, you're subject to tax on your worldwide income.
Yeah.
You know, there are different rules that maybe you won't have to pay tax on all that income, okay?
Right.
But all that income has got to be reported on your 1040,
right.
okay? And that's a big misconception. People aren't aware of that.
Now, even if you are on a visitor's visa, you stay over 180 days.
In theory, that could be the result, as crazy as that sounds. So you have to really plan in advance and look at these rules.
So they really can come after you, even if you are there for like 6 months or a little bit over than
A little
that.
bit over, yes. You could fall into that trap.
Yeah, another point there, Renee, is also the NRIs. You know, a lot of them misunderstood that they believed that being an NRI, non-resident Indian, that they invested money in India, that it was not taxable. And that statement is partially true, but it's not true because you're actually a U.S. citizen with an NRI status,
Right.
but your worldwide income, like Vinay pointed out, is worldwide income is taxed. So you had to bring that income. Even though it's not taxable in India, you're still liable for U.S. taxation.
I see. And now, when we talk about foreign bank accounts, we talk not just about savings, we're talking of stocks, dividends, mutual funds.
Yes.
Yes.
All of that.
The whole gamut.
Except stocks, you know, when you're considering the 10,000, you're just focused on bank accounts, except stocks, but everything else is pretty much.
So we're talking of bonds as well?
It could be the fine line depending on the facts, but basically it's a
You get
bank
into
account.
some complicated questions based on how you hold the stock.
That's
So
right.
let's not make a
Yep.
generalization about that.
I see. Now, what about TDS? That's the tax deducted at source.
Right.
A lot of times people don't know that, you know, if they are deducting it in India, as you mentioned,
Yes.
they forget about over here.
That's correct. So what happens in TDS, a lot of Indians own Indian stocks in India.
Right.
And the right way to do this is if your tax is deducted at source by the companies that are issuing you the dividend and tax is paid in India, then all you have to do is bring the income back into the US, it gets taxed, and you get a credit for the tax you paid in India. And a lot of us forget to take that credit. It's on Form 1116, but the net effect is zero because you're including it as income, and then you get a credit, and you should be all set.
But the important thing is you have to show the income.
That's
If you
right.
don't show the income,
You
then
cannot get the credit,
you're in part of the problems that this program is designed.
That means you have to get your statement
That's
from
right.
those
That's from the
foreign
companies,
banks.
the dividend.
And sometimes if they don't comply, well, if they don't give it to you on time, let's say for next year, June 30th, they have to get all the statements before that.
You can usually get the statements. You may not get them in a nice, easy-to-use form that you can just
Right.
move one number to your tax form. You might have to do some calculations,
Yes.
but in my experience, people can get the information for the taxes.
Now, let's say somebody had inheritance or legacy, and they got that money. That also has to be reported.
What happens is that when you receive an inheritance, that's not, in the US or in India, wherever it is, under US law, that's not subject to income tax.
Right.
Okay? But depending on the size of the inheritance, yes, you might have to file a form and disclose the fact that I received this inheritance.
Yes.
Okay.
And then certainly, any earnings that inheritance
That's right.
generates, if it goes into a bank account in India or invested in stocks, any dividends that pays are fully taxable in the US.
Well, somewhere the person is going to put that inheritance in some account.
Correct.
That is correct.
So
Correct.
it's going to generate some sort of a revenue,
Interest, and
interest.
that's what
Correct.
triggers.
So, yeah, so that means they have to disclose that as well.
Correct.
That's right.
Correct.
What we call, Renee, is a taxable event. There was no taxable event when they inherited that, but the basis becomes important. So what they inherited, say they inherited 500,000 worth of property,
Right.
that's still there, no taxable event, file a form that you did inherit this. So when you sell that property,
Right.
if you sell it for 700,000, you have a 200,000 gain. Now you'll be liable for tax in India, and then you bring that gain back in the US and get credit if you paid for tax in the US.
So that means you're going to be disclosing the 200,000, the
That's
profit that
correct,
you
the
made.
gain, the gain.
Inheritance.
So that is a
Okay.
taxable event. So taxable event is interest. Anytime you have a taxable event, that is selling a property or interest income, rental income, they're all income producing assets or taxable event. Inheriting property or buying a property is not a taxable event. It's just a fact of life.
Right. Now, a lot of times people do buy property, maybe let's say in India or other parts of the world, and they open up for a short term their bank account,
Yes.
and then they close it because they paid for that property.
Correct.
Now, that also has to be reported.
Correct. I mean, a very common fact pattern is that people here are going to buy property in India. They will set up an account in India, wire the deposit money to India, and it may only stay there for a few days
Right.
before it goes to the builder. Okay?
Right.
But in that situation, you have a foreign account, it's more than $10,000, you're subject to all these reporting requirements. You may have very little or no interest income,
Right.
but you definitely have that bank account, in most cases more than $10,000, so you do have this FBAR filing requirement.
Correct.
I see. So all this has to be reported now. Is the IRS asking for disclosures up to from 2009, or is it even earlier than that?
No, right now it's 2003, the voluntary disclosure program from 2003 to 2010.
Right.
So they're giving you an opportunity to come forward and wash yourself. I call it go for a whitewash, just or a Botox. The better word is Botox. You want to get yourself clean. You want to look
So
good.
they're going backwards to like 7 years almost.
Yes, from 2003 to 2010, you want to come clean, report everything. There will be no criminal penalty if you come forth and you're clean, washed. But if you don't, past August 31st, I see serious implications. And if they come and get you, then the penalties are really steep, including criminal penalties if the amounts
Right.
are
We
serious.
have